Hello and welcome to the show that's more volatile than a teenager's love life, the stock market. Now I know what you're thinking. Stocks? John, that's about as exciting as watching paint dry in a library. But hold your dividends because we're going to break down this financial beast into digestible and, dare I say, hilarious, bite-sized pieces. We'll be your comedic Sherpas, guiding you through the treacherous peaks and valleys of Wall Street, all while trying to avoid getting mauled by a bear market. So buckle up, Buttercup, because it's going to be a wild ride. All right, let's get down to brass tacks. What exactly the stock market? In essence, it's like a giant flea market, but instead of questionable vintage furniture, you're buying and selling pieces of companies. You know, those things that make the stuff you're probably too busy doom scrolling to actually need. These pieces, my friends, are called stocks. Think of them as tiny ownership certificates, like a world's best boss mug, but hopefully more profitable. Now, there are different flavors of stocks, just like your local artisanal ice cream shop. You've got your blue chip stocks, the vanilla of the investment world. They're big, reliable companies that have been around longer than your grandmother's fruitcake. Then there are growth stocks, the exciting new flavors with weird names like goji berry matcha swirl. They're the companies everyone's buzzing about, promising explosive growth, but also a potential stomachache if things go south. And of course, you can't forget about the value stocks, the forgotten tubs of rum raisin in the back. They're the companies that may seem a little past their prime, but are potentially undervalued and could surprise you. So, you're ready to jump into the stock market mosh pit? Great! The first thing you'll need is a trading platform. Think of it as your weapon of choice in this financial gladiatorial arena. But instead of a sword and shield, you're armed with charts, graphs, and enough data to make a supercomputer sweat. Choosing a trading platform can be overwhelming. It's like trying to pick a dating app when you're already having an existential crisis. There are so many options, each promising to be more user-friendly and feature-packed than the last. Do you want a platform with all the bells and whistles, or one that's so simple even your goldfish could use it? The key is to find one that suits your risk tolerance, trading style, and most importantly, your level of tech savviness. Remember, you're not trying to impress anyone here. Start with a platform that offers a user-friendly interface, educational resources, because let's face it, we all need a little hand-holding, and reasonable fees. You don't want to end up paying more in commissions than you actually make in profits, unless you're really into funding Wall Street execs' third yacht. Now, the million-dollar question, or hopefully more than that, how do you actually make money in the stock market? Well, my friend, it all boils down to identifying trends and reversals. Think of it like being a trend-spotting fashionista, but instead of predicting the next IT handbag, you're trying to forecast the next IT stock. Technical analysis is your crystal ball in this endeavor, a way to study past market data like price movements and trading volume to try and predict future behavior. It's like analyzing your ex's dating history to see if they're ever going to settle down, but with less emotional baggage and hopefully more financial gain. One of the key concepts in technical analysis is identifying trends. An uptrend, as you might have guessed, is when the stock price is generally moving upwards, like a squirrel on its way to a delicious nut stash. A downtrend, on the other hand, is when the price is heading south, like your mood after realizing you ate the entire pint of ice cream in one sitting. Of course, no trend lasts forever. That's where reversals come in. Those unexpected plot twists that keep the market interesting and your portfolio on its toes. Identifying reversals is like spotting a unicorn in a field of horses. It's rare, magical, and could potentially make you a fortune. Now let's talk about support and resistance levels, the invisible force fields that influence stock prices. Think of support levels as the safety net below a trapeze artist. It's the price level where a stock tends to stop falling and bounce back up, as if it suddenly remembered it had things to do. Resistance levels, on the other hand, are like those invisible walls Wile E. Coyote keeps running into. They're the price levels where a stock struggles to break through, as if it hit an invisible ceiling of skepticism. These levels are created by the collective buying and selling pressure of traders, all battling it out like shoppers on Black Friday for a discounted toaster oven. Understanding support and resistance levels can help you make more informed trading decisions. It's like having a secret map that shows you where the treasure is buried, or at least where the stock price is most likely to go next. But remember, just like that map, it's not foolproof. the market is a fickle beast, and sometimes it just likes to throw curveballs for fun. Now, before you go throwing all your hard-earned money at the stock market like confetti at a parade, let's talk about risk management. Because here's the thing about the stock market, it's a bit of a gambler's paradise. You can win big, but you can also lose your shirt faster than you can say margin call. Think of risk management as wearing a helmet while riding a roller coaster. Sure, it might cramp your style a little, but it could also save your skull if the ride goes off the rails. The same goes for trading. Having a solid risk management plan in place can help protect your portfolio from catastrophic losses. One of the golden rules of risk management is to never invest more than you can afford to lose. That means no dipping into your emergency fund, no raiding your kids' college savings, and definitely no selling your internal organs on the black market, no matter how tempting it may seem. Another crucial aspect of risk management is setting stop-loss orders. These are like financial airbags that automatically sell your stock if it drops to a certain price, limiting your potential losses. It's like having a safety net in case your high-flying investment decides to take a nosedive. Now, before you go diving headfirst into the real money trading pool, it's a good idea to dip your toes in the shallow end first with a demo account. Think of it as the training wheels of the trading world, a safe space to test your skills, experiment with different strategies, and make all the rookie mistakes you want without losing your shirt. Most trading platforms offer demo accounts, which are essentially virtual trading simulators that let you trade with fake money. It's like playing Monopoly, but instead of arguing with your family over who gets to be the thimble, you're learning how to navigate the complexities of the stock market. Demo trading is a fantastic way to get comfortable with the mechanics of trading, from placing orders to reading charts, without the emotional roller coaster of real money. It's like practicing your dance moves in the privacy of your own home before hitting the dance floor. You can make all the awkward missteps you want without the fear of public humiliation. Congratulations, you've made it to the final level, real money trading. This is where the rubber meets the road, where theory collides with practice, and where you finally get to see if all that studying and demo trading has paid off. But before you start throwing your money at every stock with a catchy ticker symbol, take a deep breath and remember everything you've learned. Start small and gradually increase your position size as you gain experience and confidence. It's like dipping your toes into a cold pool instead of doing a cannonball. You want to acclimate yourself to the temperature before going all in. Remember, the stock market is a marathon, not a sprint. It's not about getting rich quick, despite what all those shady online gurus might tell you. It's about making calculated decisions, managing your risk, and staying the course even when the market throws you a curveball. And speaking of curveballs, be prepared for the inevitable losses. They're part and parcel of the game, like taxes and jury duty. The key is to learn from your mistakes, adjust your strategy, and come back stronger. So there you have it, folks, a crash course in the stock market served with a side of humor. Remember, investing in the stock market is a long game, kind of like waiting for your sourdough starter to rise or for your favorite band to release a new album. There will be ups and downs, twists and turns, and moments where you question your sanity and your life choices. But with a little knowledge, a dash of humor, and a healthy dose of skepticism, you too can navigate the exciting world of the stock market. Just for the love of all that is financially sound, don't bet your life savings on a meme stock.